Joining us now, we've got Bernie McTernan. He is Needham Company Managing Director. Bernie, let's start with the stock move, specifically on Lyft. The worst single-day decline that we're seeing today, down nearly 34%. How much of this do you think is overdone?
Yeah, thanks again for having me. Look, the problem that Lyft is going through right now is just the investment levels were a lot higher than what the street was anticipating, both happening on driver supply, which I guess we could have guessed was going to be happening, but then they also introduced new areas of investment that we weren't expecting in some OpEx line items that are going to be going up on a sequential basis. So that's R&D, G&A, and sales and marketing expense. So admittedly, after a 33% decline in the stock, shares are getting a lot cheaper here on a valuation basis. The stock's trading at less than 10 times EBITDA. The only problem is there's just a lot of uncertainty in that EBITDA estimate in terms of, there's a lot of pricing inflation that's supporting that revenue and those bookings numbers that the company reports. And then how much the company is going to have to invest in driver supply and other areas of the business too, to just harvest. Again, Lyft has come out a much more profitable company because of the pandemic. They are EBITDA positive. Even the 2Q guidance, which was disappointing, it is for positive. Remember, this was a company that was over $300 million loss in 2019. So the company has made a lot of strides. The market's digested that. And now, so it's, what have you done for me lately? And it's that, the investment levels are just greater than we expected.
So, Bernie, when it comes to these investments here for Lyft, especially on the driver supply side, do you think these are the right investments to be making for Lyft to drive long-term growth, even at the expense of near-term profits?
Yeah, it's interesting. Both Lyft and Uber pulled up their earnings call. They were supposed to report today after market close. They moved it up to before market hours, given the results that Lyft reported in the stock market and the stock reaction to that as well, too. And so are they the right investments? It's interesting because Uber was talking about how they really think we're at a new normal here for pricing. And that, getting pricing back down to pre-pandemic levels just doesn't seem like it's going to be happening over the near term. So, I think that's a major area where Lyft, you need that two-sided marketplace. It seems like Uber is there and has it. Dar spoke about some really encouraging commentary in terms of how much their drivers and earners on the platform are up year over year. They would describe a lot of that to not only the investments that they have been making over the past year to driver supply, but then also what they're doing on the technology side too, to make just a better environment for earners to earn on their platform. So I think they would argue that, Lyft was falling behind in harvesting for profits last year when they should have been investing like Uber was.
Yeah, Emily called this a tale of two companies. When you look at Uber specifically, they say they've had more drivers than at any point in the pandemic. Lyft is struggling a bit more, but when you look at the overall quarter, Uber still posted a loss of $5.6 billion. How do you think investors should be looking at that number, given that a big chunk of that came from their holdings in Didi?
Yeah, so we're really focused on what the EBITDA of the company is. It's worth noting too. So the company's going to be generating over $1 billion of EBITDA this year, I think. And they, as I said, they expect to get to free cash flow positive. So I think that's a metric that, as we expect bookings to continue to grow in 23 and 24, the incremental margins that the company has spoken about, the 5% on delivery, 10% on mobility, plus freight had a really strong quarter. This time around, corporate expenses were less than we expected. So I think that we'll be talking about that conversion of EBITDA to free cash flow more and more, and then what the company can do to start getting some value for that cash or free cash flow generation in their business. You mentioned their minority investments. I would say that the market's probably ascribing little to no value to them. Granted, the value of those investments has really come down over the past 6 months. It's still worth a couple $2 billion. So whether it's a buyback or what the company can do to really start to get value for that free cash flow as they're really cemented as free cash flow positive, I think will be interesting to see how that transitions over time.
And just thinking about the macroeconomic backdrop, everything else going on in the world, I'm wondering how much of a boost, if any, do you see Uber and Lyft potentially getting this quarter from the fact that gas prices in the U.S. at least have started to stabilize from their March highs?
Yeah, it's interesting. Both companies really played down the gas price impact. We have a mobility supply tracker where we measure. We have 3,600 data points going back to Labor Day, where we're tracking Uber and Lyft against each other for pricing and wait times in the head-to-head matchup. And I guess no surprise is that wait times and pricing remain elevated and back to really the post Labor Day highs. And so part of that, we've heard anecdotally, there's been articles written that gas prices are playing an impact. The companies were certainly downplaying it. And Lyft in particular was talking about how, they're investing in driver supply because demand reacted early post Omicron, and then it just takes longer for supply to impact. So that's where they think that they're making those investments. Neither company commented that I believe that the gas surcharges that consumers are facing right now, even though they're relatively modest, they run out, I believe, in about 11 days for both companies. So not sure if those will continue at all either. But really what these companies are benefiting from is just inflation on the platform, where earners are making a lot more money and consumers are paying a lot more money for these services. And I don't think that's going to be changing anytime soon.
And finally, Bernie, another stock that is moving in the other direction. We're talking about Airbnb, really another strong quarter for them. It does feel like this company has found the right mix, whether it is for the short-term stays, the long-term stays. They've kind of been able to position themselves across the spectrum on travel and work from home. You've got a price target of $220 a share, certainly more upside that you see. But I wonder if we flip the question and say, what's the one thing you think that could derail the momentum for this company?
Well, I think it is a really encouraging story. One of the major pushbacks that we get, or two major pushbacks, let's go there. One is valuation. The stock's trading at a double-digit revenue multiple. Those were commonplace for my coverage 6 to 12 months ago. Now I think they're the only company I cover that's still supporting a double-digit revenue multiple. So I think that's an area for the bears. Their bears are focused on. I would counter that. We just raised our EBITDA estimates by 13% this for 2022. That means that the stock's trading about 30 times our EBITDA estimate. I think that's not quite as a lofty valuation as you get when you look at it on a revenue basis. So that's one. And two is ADRs. Company posted plus 5% ADRs in the first quarter. We had them down 1% for the year. At some point, as urban comes back, that should be deflationary towards ADRs. So we had them falling off again in 23. I think that's something where bears are focused on. And then maybe the third area where bears are focused on supply. And that's especially coming off Expedia's earnings call earlier in the week when they said Vrbo was supply constrained to an extent. On the positive side for Airbnb, they said they are not supply constrained. That's the volume and diversity of their supply on their platform, plus the innovations that they have. They called out this I'm flexible feature, which I've explored, and it's actually pretty cool. But and it's been used over 2 billion times. But the point of it is that they can move supply from constrained areas to less constrained areas. It really helps their utilization rates on the platform. So those are the three areas that that the bears are focused on, and kind of my rebuttal. So sorry, I didn't really take the bait there, but those are the areas where the bears are focused.
Yeah, the stock today up about 1.7%. Bernie, it's good to have you on today. Bernie McTernan, Needham Company Managing Director, and our thanks to Emily McCormick as well.